Hi, everyone. I'm Rick Bensignor. Today is Tuesday, November 2nd. It's election day in the US, and welcome to this week's In the Know Trader show. On tap for today's show, in our trader education portion, we're going to go kind of a deep dive into the 7-Eleven report, which I come out with each month. And we'll talk more about that. In our market overview, we'll take a look at the Dow Jones Industrials and the US 10-year. And in our sector analysis related to the 7-Eleven report, we're going to take a look at the SPDR Macro Sector ETFs, the 11 economic macro ETFs that make up the S&P 500, materials, communications, energy, financials, etc. And we'll take a look at those charts to see what they are saying and how it relates to what we do in the 7-Eleven report. As usual, to sign up to get the publications that I produce on a subscription basis, there's the weekly ETF Tactical Trader Report, comes out generally Thursdays in the evening, and gives you a good macro overview of everything going on in the bond market, often the dollar, gold, credit spreads, the S&P, and then gives a new tactical ETF trade each week, as well as goes chart by chart through every remaining open position we have until we close it out. And then the 7-Eleven monthly SPDR sector report, which we will go into more depth today. My email address, rick@intheknowtrader.com. Keep the emails coming to get lots of nice commentary about these weekly shows we do, as well as questions pertaining to the publications we have. So that's the easiest way to get me. All right, so let's talk about the 7-Eleven report. And the best way to do it is to actually take a look at one of them. So here we're going to look at September's. So it's recent, but it's now actually 3 issues old, because we do this on the first of each month. So we've already had the September, the October, and we've already come out with the November issue. So the charts here that you're going to see are out of date. The recommendations are out of date, but it's recent enough, and kind of shows you what this report is about and why you want to consider getting this. And this is more than just a sales spiel for the report. The reality is that this year, and our fiscal year for this report starts every August 1st, because we started August 1st, 2020. So we're in our second year. Since the August issue of 2021, which is, there's 4 months already, right? August, September, October, and November. We've outperformed by 1.23%. So if you annualize that, you're almost at a 3% outperformance of the S&P. If we annualize the results for this fiscal year, last year we beat by 2.6%. And if this seems like small numbers, then you don't really know what the money management industry is like, because if you can beat the return of the S&P 500 with any consistency, you are a star on Wall Street. There are very few portfolio managers who can do that over time. And we're now up 4.44%. So if you've been with us since the launch of this, you have outperformed by 4.44% in 16 months. That is a dramatic outperformance of the benchmark index that more fund managers are tagged and benchmarked against than any other. And they would often give their left arm to be able to do this. So that's why I'm telling you about this, is that I've come up with a process that consistently outperforms the market and does so in a way that is very easy for readers to implement into their own portfolios. And let's walk through it and kind of show you what we've got. So the goal of the report is all about the relative performance of the ETFs that we're in versus the actual performance of the SPY, right? The SPDR is the most traded we'll call it a stock, but it's not an individual corporate stock. It's an ETF. It is the most traded ETF and corporate stock on a daily basis for many years already. And that is because there's just both huge institutional as well as speculative trading of spiders every day. And the goal of most money managers is to outperform their benchmark. Again, this particular benchmark, the S&P 500, or the spiders that represent the actual underlying S&P 500, is the most traded and looked at benchmark. So it's not a matter of if the ETFs that we're in on any given month's allocations are up or down. It's simply, are they up more or down less than what the spider's return is, right? That's how you outperform. If the S&P is up 1% and you're up 1.3% for that month, you've outperformed. If the S&P is down 4% in a month, but you're only down 2%, you've outperformed. Yes, you lost money, but the goal here is doing better than the S&P. So we go through, we'll post the results from the prior month of how the actual S&P sectors did. We'll also show you what the actual spider sectors did, because that's what we're benchmarked to. And almost always, so if you see in this particular month, this was the results for August. On the very top line here, the S&P was up 2.9%, but the spiders were up 2.98%. Why is it that the spiders always seem to outperform the actual S&P index? Well, it's because they receive dividends. So if you're long the spiders and the component names that make up the spiders, you're actually receiving dividends, and that's why the spiders always outperform the S&P. But we're going to look at the performance of these 11 S&P sectors versus the S&P itself, and we allocate. Why do we call it 7-11? Because we will never be in more than 7 of the 11 spider sector ETFs. The goal here is to eliminate and not be involved in those that drag the S&P the most. In that particular month, it was energy. That was the worst. It was actually a negative return, with the S&P returning almost 3%. But you want to generally be in the ones that outperform, right? So that's what we try to do. So here's, for instance, at the time back in August, my call on materials, and we do this in communication service, we go through, for instance, each one of these, each one of the sectors. Both, I will give you commentary on the outright charts, and we always use weekly charts for this. So you have absolute terms here on the left. The upper half is always the absolute chart, and the bottom one is the relative chart. And it's the relative chart that we care the most about, because being able to identify if the line that represents, in this case, the XLE, the ETF for the energy sector, divided by the spider, gives you the relative performance. So in the case here from, let's just look in 2020, from winter into spring, those several months, the energy sector outperformed. How do we know it did? Because this chart was moving higher. That means XLE is outperforming spider. When it goes down, it means the spider is outperforming the XLE. So when it's moving down, you don't want to be involved because it's underperforming. So this was the secular low in energy versus the S&P in fourth quarter 2020. We went full scale bullish here, and we've been bullish the S&P with a significant overweighting. I'm sorry, not the S&P, the XLE with a significant overweighting since July, and so on. So we go through, all of the charts that we need to, and in the left-hand corner here is my call for the relative performance for that month's call versus the S&P. So in this case, back in August, I was neutral, consumer, discretionary versus the S&P. Then we'll show you a quant model sectors likes and dislikes. So we have access to one of the foremost quant models on the street. And when I tell you this, I'm telling you this after being on Wall Street for 40 plus years now. I know the bulk of the models out there, and I will tell you that this model, and I can't tell you much more about it as far as I have access to one of the most prominent institutionally followed quant models on the street. And so we'll give you information from the quant model, because what we do is combine both my calls and the quant model's calls to tell you the best way to allocate. So this page is the most important page in the sense that this hones in on each sector, what the 7-Eleven report thinks is the proper call and allocation, the quant model's call, the actual benchmark weighting. So back then, the material sector only represented 2.6% of the S&P 500. The communication sector, the next line, represents 11.4. Clearly, the technology space is the biggest part of the S&P, representing almost 28% of it. Again, back in as of August 20th, and this was the September 1st report. So we go through each one, and you can see that when we have similar, when the quant model and the 7-Eleven report, which is me, have the same type weightings, whether they're bullish or bearish, we tend to implement them such that if I'm bearish, for instance, staples, and the quant model is bearish staples, we're not going to put staples into the model. So you're not going to have any allocation into staples. In this case, I was neutral real estate. The quant model was still leaning underweight. That was enough for me to, at the time, not include real estate. You can see utilities, you can see healthcare. I was neutral consumer discretionary. The quant model was lean overweight. So on a roughly 12% benchmark weighting, we allocated 14%, a mild overweight. So we'll show you here, this is the column that you use to allocate at the time the money that you have in the fund that you are trading yourself of your own money, or if you're a financial advisor, and we have many clients who are financial advisors, this is how they will help allocate their clients' money towards the S&P. So instead of just being in the spiders to collect the return of the S&P, we have clients who are in this because the goal here is to beat the S&P, and we keep doing that. So if you add up the 3% that we put in materials at the time and 16% in communications and 5%, notice we had a double weighting in energy at the time. We moved this up to bullish, and the quant model was already bullish, and we did a full double overweight, right? So you only should have 2.5% exposure. We went 5%. Now, because we're only putting a max of 7 sectors in the fund, we have to be overweight those 7 sectors in order to compensate for the sectors that we're not including, because we have to allocate 100% of our money. So we're basically we're putting no money into, at the time, staples, real estate, utilities, and healthcare, and had to come up with, let's see, 13, 15, 8, 17, 19, 4, 24, over 25%. We had to reallocate elsewhere to come up with being 100% invested. So we allocate the money across the other 7 sectors. We tell you what the change was from the prior month. And each month you just do a little tweaking. It's really simple to do. So you take your whatever balance you have in the account, and you put 3% into XLB, so-and-so. So you adjust yourselves as needed, and to allocate as we tell you to allocate. We also show you the monthly sector rankings and percent allocation going all the way back to inception. So, and we rank them here. So we put the most amount of money consistently, ever since the beginning, into the technology space, XLK. But you can see that each month we move it around as we need to. So back then in September, we were at 36%. We had been as low as 27% in November of last year, and so on. So you can see that what's interesting here is that we have had no exposure to staples, real estate, or utilities since the fund started. We went a whole fair amount of time without having energy exposure, but then we went in February of this year, we went into energy. And we took healthcare out last December 1st and have no exposure. So it's been fairly consistent that we haven't had exposure here. And even though real estate's done well, it's such a tiny percent of the S&P that we've actually done okay. And when I say okay, again, we have beaten the S&P consistently. So as of when was this? August. This was September. So in August, we outperformed by 19 basis points. So $100,000 investment was worth, let's see, when was this? 100,000 on August 1st was up to 1.189, and since inception it was 2.94 again. And we show you every month since the beginning of how we've done. So that's the report. And we do this, every month, like I said. And since the beginning now, we have outperformed by 4.44%. So how meaningful is that? Or let's say the 2.6% in the first year. That on a $100,000 portfolio is over, in 5 years, you're outperforming by over $10,000. It's about $10,400 because of, compounding the extra, and that's on just 2%. If I go extremely conservative and pick 2% that we're going to outperform by, you're up by $10,400 in 5 years. It is very significant. If you're a long-term investor, let's say you're a 30-year-old doing this, and you're going to invest for the next 50 years, it's a massive, massive outperformance over time for the very small cost of what the monthly ETF, 711 ETF report costs. So this can add dramatic returns over time to your portfolio with a very, very small cost. And especially if you get both the 711 report and the weekly tactical trader report, the on an annual basis. So when I say an annual basis, you sign up for a subscription and you pay the year in advance. It is substantial savings, minimal cost to have the chance to continually outperform the S&P. So that's why I wanted to show you what the report was about and what it looks like, and how simple it is for you to allocate your portfolio holdings like this to, instead of just being in the spiders. And look, the spiders alone tend to outperform most people. This is outperforming the spiders. So that's why we're saying this is something that is very valuable to any investor. It's not about trading. It's about, generally, we keep things for months. Some of these things you can see, we keep for a very long time. And we don't make a lot of changes to which sectors we're in so far. We haven't needed to, because we've been spot on with what we've been doing and it's been successful. But there is going to be a period in time when healthcare is going to come back, and where the market takes a real breather in staples, and the defensive sectors are going to be back in vogue for a certain amount of time, and we're going to make the adjustments as necessary to make those happen. All right, let's take a look at some charts now as we move on to our market overview. We'll start with the Dow Jones. So here is a chart. This is a weekly chart. We are on all-time highs. We are up against a propulsion full exhaustion level here at 35,972. The Dow, as we record this on Tuesday late morning, it's almost noontime, we're just over 36,000. So this is kind of an important short-term level. If we bust through this, you can see from the sequential counts, we're still a fair amount of time away from the next meaningful time zone that this would potentially say exhaustion. So things obviously continue to look good, but we are, at a place that buying today and right now may not be, foremost on my list. You'll notice the recent sell-off that we had in August and September stopped right at the TDST line, the lowest of the 9 bars that made up the most recent 9 count. That was the bottom here 3 weeks in a row. We turn around and come right back up. We're above the cloud. We're above these trend lines. Generally bullish chart with some caution, just kind of right near current levels. The US 10-year is important because yields have again stalled to the upside. So this is the TNX, right? This tracks the US 10-year. It's simply a decimal point move. When we see the current price of 15.35, that implies a US 10-year yield of 1.535, right? So just move the decimal place one to the left, and that's the actual yield on the 10-year. We went overweight financials right here in July. And now with a stall, we've trimmed them back a bit, and I can always put them back on. But the fact that we've stalled against the TDST line, the highest high in this 9 count down, and at the same time we made a 9 count up, we're anticipating a pullback here. So a little less favorable on financials for the near term. Those are important charts in the scheme of things. Now, let's move on to the 11 sectors that make up the macroeconomic sectors to the S&P 500. So we're going to look at, now these are not the relative performance ones. We're going to look at the actual charts themselves of the spiders. So here's XLB Materials. The recent low bounces right on the 50-week moving average, this red line. Of course, a 50-week moving average is very close to what a 200-day moving average is. So here we're seeing 3 weeks in a row, bottomed into it, the same level as we saw in July. So potential double bottom. It's still in a trading range. The weekly 13 here got exhaustion for the decline. We're seeing another weekly 13 right now. It doesn't mean that you're not necessarily a buyer, but as long as this other count, the setup underneath it continues higher, it's too premature to sell right now. But notice that we're near, here, let's, I don't want a rectangle, let's put a trend line. So we are near these former highs. So I really kind of want to see this bust through older highs from this year to really think that this is going. So we're still in a consolidation phase of just going sideways, but generally the market looks like it's heading higher. And in fact, that we bottomed here where we did and above the cloud is still a good thing. Generally bullish, we're getting close to a positive cross here. So materials generally look okay, but there's probably some other sectors that may look better. All right, so that's XLB. Let's move to XLC, communications. And of course here, this peaked on a sequential, so the all-time high is on a sequential weekly 13 signal. The aggressive sequential came about 6 weeks earlier, giving you a hint. We had still climbed up the pink line, which is from the cloud model, and now most of the stall is against the baseline. We're on a 7 count now towards the downside. If we get to a 9, it's probably a buy, but it is at least still holding some support. Facebook has been now called Meta. I'm going to call it Facebook. It's still the drag here, which has really been a significant weight in this sector, and that's why we're seeing XLC, lag and not be as strong as the other sectors. Alphabetically, what comes next? XLE, energy. So again, we went full overweight here on this low. In fact, we caught the exact August low in the model. We've now got a 13 to deal with. We have finally poked through the 200 week, something this hadn't done since 2018 when it was still on its way down. So that's positive. But we do have an aggressive sequential potential upside exhaustion signal. We're getting closer to this TDST line that goes, the value there is at 61.18. We're trading at just about $58 right now. So there's still some resistance here. Break through those, boom. You've got plenty of room to the upside before the next targets at 73 and change and 70, just about 70, what is that, 78.19. No, that doesn't sound right. It should be 78. Yeah, 78.91. So plenty of room to the upside if this can get through, we'll say 62-ish or so. XLF financials. So making new highs last week, so new all-time highs, but you can see the 13s have kind of come into play here. 13 pullback, 13 pullback. We've got another 13. We're still in the midst of a new count upward, so it doesn't necessarily make me an outright seller, but it makes it harder to just simply buy them here. And again, the interest rates pulling back are going to put a little drag on financials. XLI industrials come next, have not made new all-time highs. So you have to go back to these in the spring, right? So this has not made a new high since May. So it is lagging some of the ones that have pushed forward. Really kind of in this trading range, bottom right against this bearish propulsion level, which never kicked in, bounced just above its 50-week moving average. So, you know, still is similar to the other chart we looked at before that was sideways. It's very similar. It's on a 12 count towards a 13, so same type thing. Hasn't broken out yet. Other sectors probably better, but good bounce off the recent lows. Not a bad place to be. Just hasn't gotten the extra kick it needs to really jump in and get the next leg higher. But it's potentially getting closer. XLK is next on the list. So made new all-time highs this week. Pullback was a little more severe than some of the other ones, but still held against the baseline. Why do I like the cloud model? Why is it so important? All right, well, take a look. If you go to the March 2020 low here, where I'm showing, and the market rebounds, right, climbs up kind of its pink line, the conversion line from the cloud model. Notice when it broke it, where to go to the baseline, the orange colored line, and rallies again, pulls back to the baseline. Rallies again, pulls back to the baseline. Rallies again, pulls back just above the baseline. Look how close it got, a new rallies. So to me, the longer term trend, you know how important, right now it's priced at 147.03. You know how important it is that this holds its baseline on pullbacks. So if you're a long-term investor, that's the thing you're going to pay attention to, because since the March 2020 low, every pullback of significance held the baseline. That's why I like the cloud chart. It has nothing to do with the other models we look at, but it's a very useful tool. XLP would be next. Staples, 13s, look at these. This is why this has stalled, hasn't made a new high since August. Look, all these things are bouncing and they're going higher. It's again relative performance. When you look at, you know, there are other ones better that are on new highs. So Staples are lagging and now dealing with another 13. Certainly remains an underweight type of thing. XLRE real estate, one of the better ones, is not making new highs yet. Right, so it made its all-time high on this 13, pulled back, held the baseline, turned around and making another 13. It's same type thing. It's a laggard, but it's done very well this year. I think it's the third best performer, and therefore it's still worthy of being in your portfolio as small as the 2.5% it is. Let's try to finish up here. XLU utilities, XLU. Big laggard. Look where this thing made its all-time high. So this utility is definitely, like, again, stock prices moving up of XLU, but it's not the place to be. What do we have? XLV peaked a while ago, also on its 13, getting another one now. Came a little bit beneath its baseline either. It's a laggard. And what do we need? XLV is so XLY, I think last one here. This is obviously your best one, consumer discretionary, ripping to new highs. There is a target price right up here at 204. We hit it, looks like earlier this week or today, but in general, looking very good and never holds above its baseline too. That's it for this week. We've run probably 20 seconds long. That's good. And thanks for listening to the show. This is Rick Bensignor, and this has been In the Know Trader.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.